What's up, guys? Zach here. Hopefully this is recording. What's up, guys? Zach here from iTrendz. We are going to be talking about flags and pennants today. How to trade them, advantages, disadvantages. How we can identify them. How we can trade and not trade them. Some examples and also some key takeaways. If you see some boxes in the back, also very sorry about all this light right here. I can't really do much about that at the current moment. I'm sorry, but again, it's not about me. It is about the matter at hand, which is flags and pennants and how do we trade them. Just a little note: we did actually just drop our merch line. We had dropped a merch line last year, just a small edition of some shirts and hoodies. Now we've got some more in stock. The link will be in the description. We appreciate all the support, of course, and let's just get right into it. So flag and pennant patterns, those are patterns that are continuation patterns. That's really, really important, right? You either have a reversal or a continuation pattern. A flag or a pennant is a continuation pattern that are characterized by those sideways consolidation periods that follow an uptrend or a downtrend, right? They can be bearish or bullish. Unlike other patterns, flags and pennants have a high rate of success on smaller time frames, as they often form from breakouts, which make them the prime asset to day traders, which is really, really good because we're day traders here, so we can actually take advantage of this on an intraday level, a weekly level, a monthly level, etc. Flag and pennants are almost identical. You can kind of see, let me get my laser up here. You can kind of see down at the bottom here. This is a flag, a bull flag, and this is a pennant. So they're very, very close and almost identical. There's just a slight difference. With the flag, it's more of a parallel consolidation period, whereas the pennant, it is actually coming to an apex or it's converging together, coming to an apex where it then breaks up or down. So they're just a little bit different. In my personal opinion, as a trader, I love to trade easy, nice parallel consolidated flags rather than a pennant. Sometimes pennants can be a little bit more difficult for me to kind of pinpoint where the breakout point is, and we're going to get into how to kind of pinpoint where that is. And then preferably with all patterns, but also just in general, we trade bull flags in bull markets, whether that's a bull period of a week or 2 week period, or if we're looking at a larger, grander scale, like a few months, 4, 5, 6 months, whatever it is. But we'd rather trade a bull flag in a bull market and a bear flag in a bear market. Some advantages, disadvantages. One advantage is that it's a higher probability setup, both larger and shorter time frames, which is really, really nice. Easily identifiable extension measurements, very, very easy. And it's also there's also very easily identifiable stop loss marks where you need to set your risk or reward ratios, et cetera, et cetera. Some of the disadvantages is that on smaller time frames, the pennant or the flag can be kind of convoluted and cause a non-optimal entry, especially for a newer trader. You might think that it's going to break out and buy at the top of the flag, but then it retraces back down and fails and turns into an M pattern or a head and shoulders pattern, a very small head and shoulders pattern. So you just want to make sure that you know how to trade the pattern, which we're going to go into here in a second. So with all of these patterns, with all of your trading, you want to be able to zoom out and then zoom back in, right? So we have a saying here at iTrendz: zoom out, actualize, zoom in, monetize, or zoom in, actionize, whichever one floats your boat. But we want to zoom out and we want to actualize what we're looking at. So we want to see, are we looking at a bull bear flag? Are we looking at an overall bull trend? Are we looking at a head and shoulders, which we're going to get into next week on the YouTube channel, so stay tuned for that. But the point being is that we want to be zoomed out. We want to see the overall trend. Okay, what's going on? Am I looking at a bull flag right now that's potentially in a larger bull flag, or what's going on? So to do that, we go on the weekly time frame, go to the daily, the 4-hour, hourly, 15-minute, 5-minute. However you like to progress through your time frames, we recommend that you do so. Just start wide and then come tight in. How to identify the pattern? It's very simple. It's very easily identifiable. In all honesty, it's just a flag or just a pennant. That was TOS. I'm sorry if you heard that. You can identify a flag pennant pattern on any time frame, with a majority of the patterns forming between 1 to 4 weeks, which is really, really awesome because you can take that advantage of that smaller time frame, not have to wait a couple weeks for the pattern to develop, actually play out. Excuse me. However, you can trade it on that intraday level, which is very, very nice as well. You'll see it all the time pop up. So it's really, really cool. Once you get to begin to master how to identify them, you'll see them a lot, especially when there's direction in the market. Like on an intraday basis, if there's direction, you're going to see flags, whether it's a bull or a bear flag, all the time. Very, very helpful. So a lot of times, excuse me, the flags actually form a staircase or a stair step up pattern. We kind of call them stair step up patterns, or stair step downs. But you'll see it where it's a flag. It'll have a pull, consolidation, another extension, consolidation, another extension, and then I've drawn that right here. Drew it on the presentation here. You can see the extension, first flag, another extension break out of the flag to fully form it, and then it consolidates, might form a pennant, might form another flag, and then it goes into another flag, and then just ends up staircasing itself up. So you'll see that a lot of times in the market, and this will be on more of an intraday, like a day-to-day basis, that'll overall maybe form a total of one big larger flag on a 1 to 2 or 1 to 4 week basis. So it's really cool to be able to identify this on an intraday level where you can trade it either every single day if you like to be swinging cash overnight, or you could be a swing trader and anticipating that move of, oh, we're going to stair step up right now. So very, very cool once you begin to identify that. So what we're looking for in the actual flag and pennant patterns is increased volume on the breakouts. Pretty much any pattern we have, we want that increased volume on the breakout. We have to have it, because if there's less volume than there was previously on the breakouts, then that breakout is either going to not be strong or it's going to be a fake breakout and all. That pullback consolidation phase is not overly skewed to the other party. And by that, I just mean that if you're looking at this flag right here, it's very nice, very tight, very nice. But if we were to have this flag go straight down like this, that'd be a less optimal flag, because that means your sellers in that extension period, or after that extension period in the consolidation period, that means that your sellers are gaining a little bit more control than you really want them to have if you were to continue that trend up to the upside, right? And then also it's easily identifiable support and resistance lines, right? If those support and resistance lines are kind of convoluted, you've got too much going on, you've got wicks to the upside, wicks to the downside, just wait for it to kind of settle out, consolidate, and then find those easily identifiable resistance, support, and then play accordingly. Breaks above the resistance, you know your extension measurement, which we're going to get into in a second. Or you break below your support, okay, you know your extension to the downside. Boom. So technically the entry is on the break of the resistance on the top of the flag or the pennant. However, some skilled traders do start the trade at the bottom. So they'll actually start the trade at the bottom here, anticipate the move up, and then add into the trade and play the extension. But that is absolutely for more seasoned traders. If you're a new trader, definitely don't recommend it. It drastically brings down your success rate with flags, and it could take longer for that play to trade, or that trade to play out, and therefore cause you to be risking more on the line where you don't need to be risking. So if you're a newer trader, definitely just recommend that you trade the breakout of that resistance right there. Another TOS. I'm sorry about that going off in the background, but it's literally live 12:30 on a Thursday right now, and I'm sure that I'm missing my AMD trade that I wanted to get, but that's okay. How to trade flag and pennant patterns. So we can see right here, this is a nice little illustration of what a bullish pennant looks like and what a bearish pennant looks like. As you can see again, right, the difference between that flag and pennant is only the fact that the pennant has come to an apex right here. It comes to an apex. This would be the apex right there, right? If we go back to geometry class in like 7th grade or whatever, or high school. But pennant comes to that apex, it converges, whereas that flag, it's nice and parallel, whichever direction it is, nice and parallel right here, easily identifiable. So when you're trading those flags and pennants, we look to trade the breakouts above those resistance or those support levels, depending on if it's bullish or bearish. Resistance above this resistance level for the bullish pennant, below this support level for the bearish pennant. Price trending towards the breakout during the consolidation is obviously ideal. So if that breakout is to the downside, you really want your lows to not be getting super high. Like say, let's take this bullish pennant, or this bearish pennant, for example. We want the price to be trending towards that lower support. So if we get higher highs in here and the highs really aren't coming too low, that's not really as optimal as this perfect illustration right here, where you have one high and a lower high, and then you have one higher low, and then you break through. Right? It'd be most ideal if your highs are trending lower on that bearish pennant, and then with the bullish pennant, if your lows are trending higher. So hopefully that makes sense. Oh, and then the stop loss is placed at the low of the flag. So say you had this bullish pennant trade set up and you took this trade, it was a bad break. It ended up retesting, broke back into the pennant. Your stop loss would be, of course, this is kind of more customizable to your risk tolerance, but your technical stop loss is placed at the low of the flag pennant, where personally, with a pennant, which I don't trade as often as flags, I would have cut it right at this first low because I don't want to be in the trade until this low, because then it could be just a bearish pennant or a little M pattern that kind of played out and is going to break to the downside. I don't want to be in that. And that's necessarily why I don't really, that's really why I don't really trade pennants too much, because a lot of times that fake breakout kind of gets me in the past. So anyway, here's a great example of a bull flag on Home Depot. This was from back to from October to December. So as you can see, it was kind of like a month and a half, 2 month almost trade, where you had your extension and then you had your nice perfect, this is literally the perfect ideal, like cherry picked flag that you could have found. And it was really nice. And I know that we traded it back then. But this really, really nice consolidation phase of the flag here, you can see super easily identifiable support, super easily identifiable resistance right there, and then a break of your resistance, that extension too. If you were to measure these two extensions, I encourage you guys, go back to this time frame. Look, go back to October of 2021 and then find this little run up, the period of consolidation, and then the other extension, measure them. They're almost identical in price. They're about $34 in price each. I think it was about 13% or so at the time. I can do quick math, but I'm not going to do that. Here's another good example on Roku, and this is an intraday. Note that this is a 5 minute time frame on TradingView here on Roku. So this is an intraday flag that played out, and this was a really good trade that I also took advantage of and capitalized on. This was in February, the 22nd of February actually, where we had this really nice extension. Tech was really bullish on the day on NASDAQ. You looked all around, SPY, NASDAQ, really bullish. I think I'm missing my trades right now. Oh man, this noise is high. It's so sad. It's all right. So these Roku, very nice extension with a full flag pullback here. Consolidation, very nice distinguishable support and resistance. The breakout had a nice pullback back into the flag, broke through, ended up closing. My entry would have been on this second candle, the second 5 minute candle, because I would have had confirmation of that breakout by that previous candle that broke above but closed above. That was my confirmation. So I actually took this trade. I had measured the extension. It was 7.26%. It didn't go exactly 7.26%, but it went 6.88%. I think I captured it up to this move right here, which would have been about 125. So it's a very nice trade, but it was very easily identifiable. Those setups happen all the time on intraday. You'll be able to, once you guys get into like kind of just get into or get used to identifying these bull and bear flags and pennants, you'll see them all the time intraday, especially when there's direction, it's just naturally how that market cycle goes, where of buying pressure and then selling pressure and then continued buying pressure. So this is a great example on NEO here of both a good and a bad flag back to back, literally. So this was this flag right here was taken over about a month, and then this stair step up pattern here was about a month and a half, right? So let's look at this bad example on the left, right? We have this really nice extension. Don't get me wrong, really nice extension. However, our flag pullback, although it's got a really easily identifiable, okay, this is resistance, this is support, that flag is too sharp for me. So I remember I trade NEO a lot, and in our group trades in NEO a lot. We actually have a NEO bear in our group that trades shorts NEO all the time. But NEO was on a run up during this certain period, and so we wouldn't have wanted to take this trade here because that flag is just too skewed. You can see that on over here on this good example, your flag and your pennant is not as skewed. So your control is not shifting too far to the seller side. And there's no quantitative, like there's nothing to quantify mathematically. Oh, you're like, I haven't, at least I haven't quantified it for myself. I don't know if anybody else has, but I personally haven't quantified it. Oh, your flag shouldn't be at like a, more than a 60-degree angle or something like that. I'm sure that somewhere out there in textbooks there is that. I personally haven't looked into that, although that might actually be really helpful if it was quantifiable. But it is quite obvious to look at this flag right here and see that, oh, that is a sideways period of consolidation. That is, buyers are strong in that consolidation phase. This is slightly sideways. Buyers are strong in this consolidation phase. This is very skewed to the downside, where this might actually reverse completely. The sellers are more control than the buyers, and the buyers are just losing faith as that price continues to trend down. You can see that that flag breakout was not very good. It took a while. It was very choppy. That trade wouldn't have been a very fun trade to be in. Now this over here, I should have mentioned these. This was a daily chart as well. So this over here, you can see this first flag, very obvious. Again, that consolidation period, very tight, nice and sideways. Bears have control in here. Break of that resistance, that easily identifiable resistance line, rendered you up a little bit more than that previous extension. This previous extension, if you measured it, probably would have only taken you up to this $26 mark, but I actually ran a couple extra dollars, pulled back, had another consolidation phase. You would have been able to trade the flag again on this stair step up motion, right? And then trade it up, and that extension actually went double what that was. So anyway, moving forward, the key takeaways here is that it's easily identifiable on all time frames. Just got to make sure that you can actually have a flag that has easily identifiable resistance and supports. The patterns with the sharp or those highly skewed flags have lower probability, as we just saw in that NEO example. That volume should increase when the breakout occurs on all patterns, period, but the flag especially, of course, because we're talking about that today. And then that extension after the breakout should equal the previous extension. So if you measure that extension, it's 10%. That extension there after the breakout should go 10%. And this is the way that I think about it. I put it in the last video. This is the way that I think about it. If that extension is measured 10% and the breakout of the flag goes 10%, and you're seeing this after that flag is already played out, and that extension is only 8%, to me, that's weaker. If it's 12%, to me, that's a stronger flag, and therefore that trend is going to continue up. It only makes sense. If the extension is 10%, but the other extension by law should be 10%, and it's not, it's only 8%, that shows weakness to me. Okay, maybe this trend might actually reverse. If it's 12% and technically it's supposed to be 10%, okay, there's a lot of strength there, so that might actually continue. And then finally, lastly, but not least, the breakout occurs when the price breaks above that resistance level or below that support level. So it's very, very important to keep that in mind when you are trading. So hopefully you guys learned a lot today. I know it was very quick. I kind of was a little distracted by TOS, so I apologize about that. But if you are interested in joining the iTrendz team, we actually do have a Discord group. The link is in the bio. We just dropped some merch, so feel free to check that out if you want to support the team. And we actually do have an ebook that is going to be a bundle ebook that will be going super in depth on bull flags, cup and handles, W&M patterns, indicators. It's going to be a big, big bundle that's coming out here probably March 20th. So be on the lookout for that. And of course, hit that subscribe and like button because we're a new channel. We don't even have 100 subs yet. So thank you very much. We'll see you guys next time.